A guy realizes real estate trumps the stock market, gets into multifamily, and then talks about a deal that didn't go as smooth as he planned. But lastly, he talks about a deal that is going great. So there is a happy ending here. I'm Will Harvey here with Brandon Dukeman, and this is Wealth Junkies.
This is the Wealth Junkie Show. Brought to you by CEO Capital Partners.
What's going on, junkies? It's Brandon Dukeman here along with Will Harvey, and this is the Daily Wealth Junkies Show. Thanks for joining us today, and be sure to follow us on Facebook at facebook.com/group/Wealth Junkies, and to subscribe to our show wherever you're listening to. Today's one of our multifamily segments, and with that, I'm going to turn it over to Will to introduce our guest.
Yeah, thanks so much, Brandon. So today we have John Fortes on the show. He's near and dear to our hearts because he does what we do. And so we're going to have an awesome talk with him today. He is the host of the podcast called The Passive Investor Show. He is a passive investor consultant and founding partner of Community First Investment Group. So with that, John, why don't you give the listeners a little bit more about your background and what got you to where you are today?
Thank you, Well Junkie listeners, and thank you, Brandon and Will, man. I appreciate you guys having me on my show.
Thanks for being
on
here.
your show, sorry.
Yeah.
So what got me started? So like six years ago now, right? I looked at my 401k and said, turned to my wife and I'm like, babe, we're not going to be able to do this. So I immediately started changing my focus on how can I maximize my 401k? And believe it or not, I didn't know you could do it through real estate until I got into the game. So what I was doing is I was reading books on the stock market and basically how the stocks work, bonds, and everything else that goes in that world. And I did a lot of self-development, read the Bible, about 70 books in a year. Thank you. And I landed on real estate. All the books basically kind of just guided me towards real estate. You know, everybody does at one point in their lives, Google how do the rich get there or whatever. Mm-hmm. How do the success do it? And majority of them are like real estate. So
real estate.
I could completely understand it. I knew how equity worked because of the value of my home. And then I have a lot of friends that flip houses. I don't flip houses, though I am tempted to do at least one because my wife has unbelievable taste. So nice. She'd be able to put it together really well.
HGTV and all that stuff.
Yeah, but you see my kitchen. She really did a really good job on it. So with that said, I started, we went down the Bigger Pockets really helped me out. We went down the rabbit hole of a single family home, and we bought one. And the day we closed, I turned to my wife. I said, I can't do this. I can't do 100 of these. We can't do 100 of these. I think we need to do multifamily. But what's funny is in the time that I found that purchase, that identified that single family home, I was already immersing myself in multifamily. So I was already pot committed with the single family, and I was like, all right, I'm just going to take it over and then shift my focus on multifamily after I close. And the day I closed was literally the turning point because I didn't want to fill out all that paperwork again on a residential home. So moving on to multifamily, and after you close a few deals with that, you understand the paperwork, logistics side of that. But what happened was we joined the community. We joined the Jake and Gino community. We partnered with a few people. Well, we formed the company, Community First Investment Group, with my Mitch, my partner. That's one of the original founders who we formed it because he does my taxes. And every time I go do my taxes, we talk about opportunities to save taxes while building a business. So we always kind of like talked a partnership through it, but we never even knew what we were going to build a business on. And we partnered together. And a few months later, we found our third partner, and then turned into Community First Investment Group. and we took down a 62 unit in October of last year.
Nice.
And then about 4 or 5 months later, in February, we closed and syndicated a 41 unit. Now, the 62 unit came up by way of JV. So a lot of people ask me, how did you do that? When I say JV, we have a bunch of partners that are like-minded individuals, and we came together and put that one together. Now, that one's the one that's been more. We could dive into that one more because
absolutely,
everybody does the syndication and talk about that, but the syndication has gone exactly how you've probably already heard the format already. Raise capital, close, cash flow at like 9% right now. So
great.
There's nothing really to dive into on that model, but if we wanted to focus on the 62, that would be.
Yeah, and before we do that, you mentioned JV. For the listeners that don't know what JV stands for, you mind just telling us what JV is?
Yeah, it's a joint venture. So, for instance, I found a product, and Brandon and Will, we just kind of pool our capital together and take it down together instead of going the syndication route. So,
right.
We'll identify each other's roles because you have to be specific with that, and everybody has a task and a job to do, unlike the syndication model where there's LPs and GPs.
Right.
What can you explain what an LP and a GP is?
Absolutely. LP is a limited partner. So basically a busy professional who is just seeking returns. So if you're, if you love your day job and you don't see yourself ever leaving it to go focus on something else, or you just want to scale back the hours you're working, you can create another stream of income by passively investing in these opportunities by way of limited partnerships and any private placement memorandum. So, And did you ask about the GP?
Yeah. So explain that as well.
So the GP is the general partners, the people that put the deal together, sponsor the deal, sign on the loan, found the deal, and even co-invested side by side with the investors. Usually 5 to 10% of their capital goes into the LP side, along with the investors, so everybody feels comfortable.
Right. The analogy that I always use, and I stole it from Old Capital podcast, is a commercial airplane. So the pilots and the crew, those are essentially the general partners, the GP, and the limited partners are the passengers. So everybody's going in the same direction and has the same goal. They want to take off, fly, and then land safely. And but there's a group tasked with essentially managing that and making sure it happens. So and then the limited partners are just along for the ride. So
shout out to Michael Becker and Paul Peebles.
Yeah, they're great. So absolutely.
So John, you talked about this 62 unit that you'd like to dive into a little bit. Why don't you tell us a little bit how you found this deal or how it came to you and where you went from there with it?
Yeah, so since we're part of a community, Jake and Gino, shout out to Jake and Gino, their community, their private Facebook group, where we got our education from. A few partners came together and, they were putting this deal together, and we saw the potential and the value in it. It was 70% occupied at the time, and we needed to go ahead and do a lot of renovations, about $9,000 per unit.
Wow.
And and $100,000 on the decks outside because the decks weren't up to code. So we went in with a bridge loan. We currently still have it. We're actually coming to the end of that one right now. So, and
explain what a bridge loan is. Yeah, explain what a bridge loan is.
Yeah, awesome. So the bridge loan actually helps with the repair costs too, but on a draw basis. So what you do is you front the upfront cost of the bridge of the project, where let's just say we did 25 grand in renovations, and then they come and inspect it, and then they release that 25 grand back to you, and you keep moving forward with the project. So that was the bridge loan. They covered, I believe, 70% or 75% of the LTV, loan to value of the project, and then they've covered the repair costs. So our going in capital, we're already at $575,000 into this property at the end of the day.
Okay. Yeah. And a bridge loan, when you compare it to, say, an agency loan, which would be Fannie Mae or Freddie Mac or HUD, bridge loans are are used when the property is a lower occupancy than what Fannie or Freddie would like. They tend to like things around 90% or at a minimum or greater. And the property you bought was at 70, so you wouldn't be able to do Fannie or Freddie debt on that. So you had to get a bridge loan, which comes with a little bit higher interest rate. And I don't know if it had to be personally guaranteed or not. Yeah, sounds like, yeah, you're nodding your head. So yes. So that's kind of the drawback there, but it's needed to acquire the property. And I assume that the goal down the road is to refinance it into a long-term Fannie or Freddie loan. Is that right?
Yeah. So at the end of the day, we're looking to be at a $3 million valuation, and we're looking to refinance after basically 3 months of seasoning with at 90% occupancy into a small business balance agency debt. So,
very
fingers crossed, right?
Very cool. So you said that you had a few issues before we started recording this. You talked about how there were some issues with this property and it had a little bit of hair on it. So can you explain that and just talk about it? Because everybody talks about the rosy, perfect deals. We want to hear one that maybe isn't as perfect as you would have hoped.
No, absolutely. So if you got something with 70% occupancy, you got to go and turn the units over. And I'm going to throw another caveat on that. Everybody is month to month on their leases. You want to go in and communicate properly to everybody, I'm on takeover. And that's something we didn't do. We didn't communicate that, new management is here, blah, blah, blah. Only communication piece we did was, actually, I think we did communicate that we acquired it because new management came in, new property management came in. And I remember we did. But the only thing we didn't communicate was that we were going to renovate units and put tenants in newer units. So the reason why that's an important piece is after that communication letter, we cleaned out building 1. So building 1, we told them they had to be out by a certain date so we can start renovating. So we were behind the 8 ball because it took us some time to do that. So we lost time on the bridge clock, right? So which is 1 year before it balloons. So what we did was once the building 1 went, tenants talk. So building 2 started vacating, building 3 started vacating. So prepare for the mass exodus, if you want to call it. And since then, so if we had it just as is and building 1 was empty and building 2, well, it happened slowly. So building 2 and 3 vacant in probably over like a 2-month time. So as it was still going and up, it was basically breaking even. So what I mean by that is all the expenses were paid. Investors are not paid, but expenses are paid. So that's the goal, is to have expenses paid while you're funding the rehab process on a deal like that. So if you can do that and delay the returns of your investors, say like 2-year delay, the returns on the back end or going forward when you start cash flowing it's a really high cash on cash return and all of that. So and you get the opportunity to potentially get all your capital back upon a refinance if it's done correctly.
Yeah. So is that still, or is that still an option? Is this just kind of something that was unforeseen and now you're just correcting course and
yeah. So other issues that came about was we had contractor issues, and lenders tend to understand that contract issues happen. So we had contractor issues happen. So we had contractor who we hired for the job. He didn't have the manpower, so that kind of killed some time on that clock as well. So we now have a contractor that has the team that can literally blow through the units. And just to give you an idea, we have about 11 units at the end of this week coming online to rent. And that's been a long time since we've been able to have tenants in that building.
Nice.
And we still have hurdles to climb on that one too. We need a certificate of occupancy cleared by the city. We need inspections on certain decks to be cleared by the city before we can even start putting people in the building. So our property management company is patiently waiting on a timeline because they are communicating that they have a lot of interest from people calling because they have marketed it on their website. And since we took over, we have rebranded, changed the sign, changed the signage, rebranded it from Timberlanes or Timberlakes or whatever. Timbers North, to now it is Buffalo Ridge. It's in Johnson City, Tennessee. And we've really done the exterior. I believe one of the things on the exterior that we need, and it's remaining, is we're going to do the repavement, and that's all budgeted in as well. So that it'll really make the area really look nice. But the units look awesome.
Yeah, very cool. So it sounds like you're basically you're kind of ground zero right now and just building it all back. You're getting units online and getting tenants in it, and it's kind of stopping the bleeding. And eventually this will be turned around.
Oh no, it's still bleeding. So I'll tell you why, right? So the reason why it's still bleeding is since the tenants moved out, right?
Right.
We've had 3 now capital calls.
So, oh wow.
The fact that this isn't a syndicated deal is easier for us because we're all invested in this deal, and we're over the hill of it, and we're basically seeing the drop, even though we have two more buildings to go. So the reason why I say that is because building 1, we can finally put tenants in it, and now we have the crew that's going to blow through these units. So like I said, we have 11 units by the end of this week, and it's projected by the end of next week we'll have, I believe, 3 more, So it's just getting that building to where we can just, stop some of the bleeding for us. And then building 3 is next, and then building 2 is last. So once building 3 is up, the bleeding will be stopped and back to break even. Not completely up, but it just needs to have a few other units to do that. So the capital calls part is not fun, but it's understanded when you're JVing and you understand the whole situation. Now, if that was to happen on a syndicated deal, the investors would be questioning you.
Yeah, they would not be very happy with that.
Yeah, why did this happen? I thought you had a plan for that. What was your business plan? Everything would be just questioned. And for a deal like this, if you don't go in explaining to your investors the potential of, look, you're not seeing anything for 2 years, if you was going to syndicate a deal like this, I would say prepare for everything to hit the fan, right? So what I mean by that is prepare for months on end where no tenants is in, and prepare for bad contractors. Just kind of prepare for the worst.
Yeah.
Right? So
kind of an Armageddon kind of.
Yes.
Yeah.
Yes. If you're going to just kind of hope on the break even, you want to pencil in maybe a loss,
Got it.
So over raise on something like that, because the returns would still, put it this way, you could give back money that you don't use.
Absolutely.
Right. So the investors won't mind you giving back capital you don't use.
Yeah.
Over going out and saying, hey, Will,
I need some more.
We need another 15 grand from you.
Mm-hmm.
Right. So looking back in everything's 2020 in hindsight. So is that, were you just undercapitalized? Is that the ultimate, what created the need to do capital calls and just why it's not performing as you thought it would?
Yeah, so that goes back to communicating with the tenants, right? So saying we're going to put you guys in a newer product as soon as we start renovating. So what I mean by that is if you can, we kind of depended the deal on a break-even model, right? Instead of a mass exodus. And the fact that we're getting, we're funding, we have $100K going into the CapEx budget, and getting refunded every time we complete a phase of the project. So when you do that, you're dependent on the returns and how fast those draws are coming back to you, which they happen pretty quick once they get approved. It's just a couple-day process. But as you keep mowing along with the if you have a good crew, you can keep up with that pace and that level if you're going through that process. But having a crew that's undermanned really slows it up. And when you're slowing up, it takes longer time. So now you're wasting more money because time is money at the end of the day on a project like this. And when you're trying to just get it to a certain point, it shouldn't take a long time to get a building up and running. Never mind 2 and 3. And that's just kind of like a little bit on us. I take the hit, because we want, we want to vet a contractor that has the manpower to do it at the end of the day. So, I'll take the hit, but you know what? The best part is I don't have investors in this deal. It's my money.
Right.
Right.
So John, you talked about, once this property stabilizes, you're expecting a $3 million valuation of the property. Can you kind of talk about how these multifamily properties are, valuated on sale and purchase price?
Yeah. So they're going in, we bought it for 1.2 with a bridge loan total of 1.7. So we bought it on actuals on how it was performing. And what you was basically describing is when you're buying on how it's performing, that's how it's evaluated. So if it's making a certain amount of money and if it's making a certain amount of money and the potential of what it can be at, that's basically where you can take the building through your business plan. Because if you go ahead and let's just say a newer product, which this asset is going to be a newer product, it's going to be about, I believe, $100, $150 swing. I can't remember exactly. I've looked at so many other properties since then. But the formula to do that right now off cuff, I can't remember what it is. But it's just, that's why I have my partner Mitch underwrite. So I like to, Mitch, he's fascinated at underwriting. He's he's I forgot to introduce my partners. So Mitch, who does he's his bachelor's in financing and he's got his master's in taxation. So it's a double whammy.
Yeah, he's the perfect guy for the underwriting.
So when he's evaluating the business, and we're pretty conservative on that, if you can buy it at on how it's performing today and implement your business plan and go ahead and increase the revenue, whether it's by rents, services where it's trash valet or something like that maybe on a B-class asset, on a C-class asset like this, we're doing move-in fees where instead of security deposits, maybe there's a $500 security deposit, we're splitting up that $200 into a move-in fee and then a $300 into a security deposit. So that's building more NOI into our
NOI is net operating income.
Yeah, so it's increasing that into our proceeds. Instead, now we only holding 300 for that tenant instead of actually the whole 500, where potentially we might have to give it back if they don't do anything. Which, if they're a good tenant, that's what you're hoping, right?
Yeah,
right.
So
exactly, that's awesome. So you just do various things to essentially raise the rent that you can charge, whether it's from pet fees or something else, and you renovate the units, make them nicer, and that commands a premium compared to what it was before, and that ultimately raises the income that you generate and ultimately the value of the property as well.
Yeah.
So very cool. Well, why don't we shift gears? And Brandon, I don't know if you want to dive deeper into anything there multifamily related, but now that was kind of the tougher deal. Let's talk about the one that came after that, the 41 unit that you did syndicate. And I'd love to hear about what you do in terms of educating passive investors and all of that. Now we're shifting into the syndication side of things.
Yeah, so the syndicated deal that came through one of our partners as well. So he really didn't know the model of syndication, and I live and breathe this stuff. So, excuse me. He came to us and said, can you help us syndicate this deal? The lender is telling me I can't basically JV it because of X, Y, Z or whatever his situation was. So I said, yeah, sure. Let's look at the deal. The deal checked all of our boxes. we went in, we actually invested alongside with this deal as well. And we helped raise the capital as well. So my partner was there on the inspection day, Matt, who's also a partner of ours. He's out of Florida. He has his own inspection company. So the day of the inspection, he was there with the other inspector, and he's dragging him around the place saying, hey, check this, check that. So we were very, very thorough. Nice. Not that the inspector wasn't doing his job or anything, but Matt had a lot of priorities that he wanted to check, make sure.
Skin in the game.
Absolutely. So right. He's making sure that's what he does though. He knows what to look at.
Great.
So if I'm at a property, I'm like, oh, cool. Look at that open space. He'll be like, oh, no, that's like a runoff, a water runoff where the water's running off away from the property. I'm like, how do you know?
That's funny. Right. So he just has that eye for.
Yeah. So, just another thing is he's so good. He inspected a 200 unit property in northern Florida. I forgot where it was. It might've been Gainesville. So it was from another community member that had a 200 unit on the contract. He went and he got video on it as well too. So he inspected the roof, and he's flipping the roof was basically 3 years old. So they said he's flipping the shingles over like a deck of cards. And he's like, whoever put this roof in didn't nail them in. And he's just like flipping. They didn't nail them in completely so the actual people the sponsors actually went back and retraded, and they couldn't get what they wanted, and they walked from the deal, and Matt saved them from a potential heavy CapEx.
That's awesome.
Yeah,
it's great to have him on your team.
Yeah. So another thing too is we thoroughly vetted this deal. We helped bring in our investors in this deal. We stay on top of it. It's cash flowing like 9%. It's kicking off right now to the investors. It's just really performing. I think it's already performing at the value that we already said that it would be evaluated at. Awesome. in year 3 or 4. So
wow,
it's crazy. We've done some unit turns in there. We've bumped up the rent. We were conservative at I believe one of the rents went up to 700, and it was about 50 to 75 below market. It's just really, really performing well.
Nice. So how are you getting these passive investors to buy into what you're doing and ultimately write you a check for 25 or 50 or 100 grand or whatever the minimum amount is on?
So I'm listening to the investor. So every investor has different criteria. So some investors want to come in at just like a 10% kickoff with no equity, right? So they try to avoid like they don't want equity because they're tax implications or something. They just want to kind of be like a hard money lender or something like that.
Okay, I got you.
Or there's investors that want part of the upside, and they want maybe a little pref, and maybe
a pref is a preferred. Can you explain what a pref is?
Yeah, preferred rate of return is, for instance, let's just use the model 6%. I'll just throw that out there.
Right.
So whenever the returns come in, they get 6% right off the top, and then it's split down to their equity percentage. So if it's a 70-30 split, 70 to the passive investors, 6% preferred rate of return. So 6% gets kicked off to the investors first, and then the remaining proceeds get split up 70-30, 70 back to the investors.
Right, and then 30 to the general partners, and it's all deal by deal specific. We've done deals with a 7 pref and 65-35, 70-30. Yeah, so that's great.
I wouldn't really focus on the pref, and I tell the investors, I said, don't focus on the pref, focus on the annual rate of return. That's more important to me. And I try to get them educated on that aspect, because the pref is good, but if the property's like, the pref is good to me, but if the property is just an okay asset, it's a stable asset, like the pref really doesn't mean anything if your annual rate of return is like below 10, so
right.
If you can get the life of the deal like a 15, that's great to me. So
right, I agree.
That's what I focus on.
I agree.
Yeah, but the thing is, a lot of people focus heavily on pref. Like, well, what's the pref? What's the pref? I got investors, and you asked, how do I get investors? I got investors that just focus on IRR, internal rate of return. That's how fast they get their original capital back. So that's why we look for heavy value add deals. And if we can do it right, we like to build in a 4-year hedge in that, sometimes a 2-year hedge on that. But a 4-year model really protects you really with your investors. And if you're holding it for 4 year, maybe on a it's not gonna take you 4 years, but to cash them out on a refi. But also we don't model it with a refinance because of the simple fact that we don't want the deal to be dependent on a refinance.
Right. You don't want to speculate.
And then for the people that just kind of want 10% going in or 10% kickback and with no equity, those deals look like they have no equity. So when you return their capital, they're done. They don't get any more returns.
Okay.
And they're just moving on to the next deal. So that's what's kind of cool about that model as well. So it depends on what the investor is, and you got to listen to them. And when you're providing opportunities, our model isn't, we're not like a strict 4 prep 70-30 split. It's scaled very differently.
Right.
And I think the whole market's that way too, because a lot of these deals from the top syndicators are showing that A-class preferred A-class where it's 10% kickback on the life of the deal, no equity, and then a B-class, the original, like whatever the preferred rate of return and equity split is. So, it all depends on the investor. What are you looking for?
Right.
So, John, you got your own podcast show. Why don't you talk to us a little bit about that and, what your goals are, with that show?
Thank you. It's the Passive Investor Show. So you can find it on any podcast platform that you favor listen to, that whatever your float your boat on that. But what I do is I focus on time. The busy professional lacks time, and how do you create more time? You create more time by passive investments. Passive investments help you scale back your hours at work, help you gain back hours that you could put towards your family or vacation that you've been wanting to take your family on. Or maybe even you want to travel the world and you want to kind of start creating some passive income returns. If you got enough, a good job that allows you to just contribute a significant amount of capital into these deals to kick off, a return that is favorable that you're looking for. That's what I focus on. I focus on real estate as well. So doing it through the means of real estate. And if the busy professional is looking to buy back some time, that's what I truly focus on and talk about. And I keep the podcast really, really short too.
That's
Beautiful.
Good. That's good.
That's awesome.
So,
well, Brandon,
all right, John.
We're
going to transition right into our moments of truth. John, these are the same 7 questions that we ask all our guests here. All right, so we're just going to dive right into it. John, who is your success role model?
My success role model, my dad. My dad came in this country with nothing, and he what's funny is his first purchase was a 3-family, and then we finally bought our own home. So basically, he house hacked his way into without even knowing it, into a single family home for the family. So my dad is my cool. Success role model, man.
That's awesome.
Awesome. What is your biggest success thus far?
Biggest success is I don't know, marrying my wife.
Yeah, no, it doesn't have to be business-wise.
No, she allows me to be me, and I don't fall for get-rich-quick schemes. I thoroughly vet everything, and she allows me to bounce ideas off her. And if she says it sounds too good to be true, I'll dive in. Or if it sounds hard, my goal is if I present something to my wife and it sounds hard, I feel like I'm kind of on the right track, because not the normal person is thinking about that.
Right. Beautiful.
John, what's a typical day for you look like?
I've been lacking on this, but I try to wake up early and meditate before I work out. And those are the 2 things I really, really try to hammer every day. And then my wife bought me the passion planner, because I try to structure my day accordingly. and that allows me to coordinate my month, and then it allows me to coordinate my week. So I try to be very, again, I go back to time. I try to be very, what's the word I'm looking for? Time focused.
Efficient.
Yes. I'm very, I'm very, very focused on my time and what I'm giving my energy to during my day. Yeah. So when it's family time, my phone is typically away. And then at night, when I need to pick up and look at an email or something, that's when I'll get back to whoever I need to get back to. So I dedicate my time in blocks.
That's important.
Very cool. Important. John, what's your favorite quote?
Favorite quote? You did say this one would be the tough one. I use a majority of them. So I have my vision board here. So dreams are for chasing. I just got things that just remind me to laugh as much as you breathe, love as much as you live, stop wishing, start doing. I just keep everything. Nice. I write up new ones, or I find new ones that I can just tape up there on on my vision board.
Those are all great.
Appreciate that.
Yeah.
John, what are some of your hobbies?
Oh man, I don't know if I have a hobby. So I just immerse myself in doing whatever I do. So I there's things that I just really love. So I love real estate. So I remember Brandon at the conference, we could have spoke about this all day, all night. Mm-hmm. It was just fun.
Right.
But there's other things that I do. I referee basketball games. I do the college level. So I really, really love that.
And John, if correct me if I'm wrong, but you've got a pretty interesting goal for reffing basketball. Is that right? Pretty unique dream.
Yeah. So my goal
is from the
is,
first time we talked. I remember this.
I appreciate that. My goal is to do TV games, man.
Yeah.
So
nice.
Whatever that equates to. So, I appreciate that. Oh, another hobby of mine is just watching my kids do what they love. So my son, I'm a basketball junkie. And my son loves basketball. And I did not put the ball in his crib. I didn't do anything like that. I just let him chase it on his own. So whatever he chooses, and my daughter's just whatever she ends up loving, I just want to follow that path and see them succeed.
Very cool. It's very cool. I love it. What's the best business book that you've read?
It's the Purple Book. That's always awesome. Another one. It's actually two right after that. It's Oren Claff.
What is the Purple Book? I know what it is.
All right. Yeah. The Purple Book, what's funny is almost like the Purple Tape in hip hop. It's Raekwon's album, right? Yeah. So the Purple Book is Rich Dad Poor Dad. Yeah. And
it's a turning point for most real estate investors, that's for sure.
I just got done reading Fake too. That one is probably I would say probably better than the Purple Book. I
agree.
Opinion.
You need to read the Purple Book first, but Fake just blew my mind.
Yeah. But my favorite two books is Pitch Anything, and it's his new one that I just finished reading. It's Oren Claff, Flipping the Script. Yes, those two, man. Those two are Oren Claff. He's just a favorite of mine. So, man, he's awesome.
Great.
Cool. John, if there's one key piece of advice that you could leave our listeners with about achieving success, what do you think it would be?
All plans are basically just plans until you're actually doing it, and just be prepared to be punched in the face, right? So just expect the worst. Quote. Yeah, absolutely. Yeah, so you knew where I was going with that one.
Oh yeah, I have it.
So everybody has a plan until they get punched in the face. So with that said, just be prepared and take the punch and have that Rocky Balboa mindset. I'm a big boxing fan, so hence the boxing references. It's not about how hard you get hit. It's about how, you get back up and face it. So,
great.
Get punch drunk sometimes and you're going to feel it, but how can you counter?
Yeah. And how can you learn from it?
Yeah.
Yeah. That's awesome.
Yeah. So John, what are some of your wants and needs for your company and your podcast and everything moving forward from today?
So we work with other operators and co-syndicate deals. So if you're in our target markets, where currently we look in Florida, Central Florida, going up to Gainesville, and Tennessee, where our 2 assets are. One's in Chattanooga and the other one's in Johnson City, but we look at the tri-state areas as well and stuff like that, like Nashville. And obviously it's really hard to get in there, but we look to put our investors and opportunities in those locations. The reason why we focus on red states is because the landlord-friendly laws. If I was to do it out here in Massachusetts, understand that I'm trying to run a business and it could take me 9 months to, get a bad tenant out. So, and that all comes down to the vetting process. So, but not everyone passes, some people slip through the cracks during the vetting process, and they can really, really hinder your business if you're buying a smaller unit. So that's why I focus on these bigger assets.
Great. Cool. That's awesome.
Yeah. So John, how can our listeners get in contact with you? If they're looking to invest, or hopefully maybe someone wants to try to get on your show and get an interview in. How can they get in contact with you?
Yeah. So if you're looking to get on the show or passively invest, you can go to johnfortes.com, or you can go to passiveinvestorshow.com. It'll bring you to the podcast. It'll bring you to the site. There's a contact form there. I don't do any newsletters on that site. The reason is I'm working with busy professionals who value their time, and I know that sometimes newsletters don't really translate to their time. So they want opportunities, and when they submit a form on my site, we go and we vet them out, talk about it, and see if they're a perfect match. If we can line them up with a deal, then that's the goal. That's the goal, to help them free their time. So that's where I focus right now. So appreciate that.
Cool. Awesome. All right, guys. Well, that wraps things up with John Fortes here. And that is the multifamily segment of the week. Again, don't forget to follow us on Facebook at facebook.com/groups/wealthjunkies, and to subscribe wherever you're listening to, and comment and leave us a review. Let us know how we're doing. John, we appreciate your time today, and we'll see everybody tomorrow.
Man, thanks, thank you for having me, guys. Appreciate you guys. Good luck, and God bless, fellas.
Thank you.
You've been listening to the Daily Wealth Junkie Show, brought to you by CEO Capital Partners. CEO Capital Partners works with business owners and executives to build passive income through multifamily apartment syndications. For more information about how you can invest in quality multifamily real estate assets and build significant streams of passive income, visit us today at ceocapitalpartners.com.